Randomly picking stocks is not investing, that's gambling. And let's be real, you're probably not going to be making millions from GameStop. Hey guys, this video is going to be about how students and beginners can get started in investing in the stock market even if you don't have a lot of money on hand. I think it's really important for women to emphasize the topic of personal finance and investing since not a lot of women talk about it on YouTube. Before we dive in, make sure to like the video and subscribe to the channel if you haven't already, and make sure to hit the notification bell so you don't miss a new video from me. So before you start investing any kind of money into the stock market, you need to make sure that you have at least 3 to 6 months worth of expenses and that you pay off all your debts. To this point, you should only be investing money that you don't have and are willing to not touch for a pretty long period of time. I'd say at least 5 years or so, just because you don't want to be going into your investments if you need to pay off some kind of expense or debt. So make sure you do that first before you think about investing into the stock market. So after you've done that part, what is a stock? A stock is basically a tiny piece of a company, and you can think of it as having some sort of ownership into a company. So for example, if a company like Apple has 100 shares and you own 1 share, that means you own 1% of the company. But in real life, there's going to be millions and millions of shares in a company. So if you own a few shares, you're only earning a very tiny piece of the company, but that's the idea of what a stock is when you trade it onto the market. Okay, so now you may be wondering, how does a stock make money when I hold on to it? There's 2 main ways that holding a stock makes money, and it's by stock appreciation and through dividends. So stock appreciation is when you hold on to a stock, let's say you bought it for $10, and over time, the stock grows in value until, let's say, $12 a month from now. Stock is growing in value, which means it's appreciating. And the second way is through dividends. And dividends is when some companies provide their shareholders a form of a cash payment as long as you hold onto their stock. And it's basically free money if you hold onto the stock for long enough. And who doesn't like free money? The idea of it also is to make sure that you buy low and you sell high. You want to make sure that when you buy the stock, it's a lower price than when you sell it out, and that's where you make your profit. Alright, so why do people invest in the first place? Investing is a way that money makes money for you instead of you actually actively working to make money. And investing is actually the easiest way to make money with doing the least amount of work as long as you start out with some sort of capital, which is cash. But basically, if you are working a job or starting a business, it requires a lot of time and energy from yourself to make that amount of money. But if you invest it into the stock market, all you have to do is, once you do your research and plop your money into some sort of stock, index fund, or other investment, you just plop it in and it basically just grows without you having to do any sort of work after that. It's one of the most passive income sources that you can do without much maintenance or work from your end. And I doubt that most people would want to work until they die, so having your money work for you is one of the most efficient ways to grow your wealth and net worth. Also, just a side note from your money growing in value, if you keep your money in a checking account, they have horribly abysmal interest rates. With inflation, your money is losing value every single year that you keep it in your checking account and you don't invest. So the main reason why people are so attracted to investing is due to the idea of compound interest. So compound interest is mainly the idea that you are gaining interest on top of interest. So it actually really snowballs into effect if you invest over a really long period of time. Basically, if you start earlier, you have more time in the market to compound that money and to make more returns on top of those returns. So let's look at a scenario between 2 people. So let's say there's person A and person B. They both invest $500 a month at an average return of 8%, except person A starts at age 20 while person B starts at age 40. And we're going to assume that they all retire at 65 years old. So person A, by age 65, they will have over $2.3 million with only a $270,000 amount invested into the market. Person B will only have $400,000 by the time they are 65 years old, and they will have a total contribution of $150,000. It'll be super slow at first because you won't be seeing that much of a return, but your investments will definitely begin snowballing and starting to increase exponentially once you hit that point when compound interest is really starting to work for you. The next idea that is really important to know when it comes to investing is diversification. And the key to diversification here is to not put all of your eggs in one basket. Let's say you're doing individual stocks. You want to make sure that you have a diversified portfolio, which means you are investing in several different kinds of companies. So if one does bad, you have the other ones to keep you afloat. I think a better way, instead of doing the research yourself, is to just stick your money into the S&P 500 index fund. It's the US top 100 companies. So if you invest in something like that, you're already diversified. So when you are diversified, your eggs are not all in one basket, and you can feel a lot safer in your investments and, sleep better at night. What do you actually invest in now? So basically, I would divide this into two ways of thinking about it. So there's active investing and passive investing. When people think of active investing, it usually means that you're picking individual stocks and researching all the company's fundamentals. You can start by looking into companies that you like. So for example, if you use like Apple computers, you can look into investing in Apple and check out some of their news, financials. Also want to add that a lot of people online tend to talk about the companies they invest in. And just want to preface that even if you think they're talking about something that you resonate with, you should still definitely do your own research just to make sure that you understand why you're investing in a particular company. And also, picking individual stocks is extremely risky. Like, all stocks have different levels of risk factors, so you also have to be able to understand what your risk tolerance is and how much you're willing to put into individual stocks, because there is a pretty high chance you will lose money by picking individual stocks, in my opinion. Let me tell you this. Picking random stocks is not investing. That's gambling. If you're not informed why you're putting your money into a specific stock or company, it's no better than blowing your money at a casino. When it comes to individual stocks, I've also made a few mistakes when I first started out, and to be honest, I've lost some money by doing individual stock picking, and I definitely was grateful that I learned this lesson earlier when I started rather than later when I had a lot more money that I could potentially lose. So the second method of investing in the market is through passive investing. This is good for the majority of people who don't want to spend tons of time researching companies and having to actively manage portfolios. For passive investing, most people just put their money into an index fund. Like I mentioned earlier, the S&P 500 index fund is a really good pick for most people because it tracks the broad market as a whole. The average return is about 8%, which I think is actually a pretty good solid return for the average investor. Passive investing is definitely really great for, I'd say, like 98% of the people out there. So after you do all your research about where you want to invest your money, it's time to actually open a brokerage account in order to get those stocks. A brokerage is where you can get access to stocks and other types of investments. You have to open a brokerage before you can start trading. So some of the reputable brokerages that I would definitely recommend are Vanguard, Fidelity, Charles Schwab, and TD Ameritrade. So those are really good reputable options to choose from. But I know sometimes as students or beginners, when you don't have like a ton of money to start out with, it's really great to be able to find a brokerage that has fractional shares. So you can just buy like a piece, like a fraction of a stock that can cost a lot less money than having to buy the entire share of a stock. So some brokerages that do fractional investing include Robinhood, and there's also a site called N1 Finance, and you can also buy fractional shares through them as well. There are tons of other brokerage platforms out there, so just do your research and pick the one that you think is right for you. When it comes to investing, I think sometimes when you're looking at the market and how it's like going up and down all the time, it's hard to not let your emotions take over how you invest in the market. And the market is not like linear, right? Even though it goes up over a long period of time, day by day, it's like going up, down, up, down. Sometimes it's really discouraging to see the red on some days, and other days when it's green, you feel really happy. At least that's how a lot of people, including myself, are wired to think when it comes to like your money and stuff like that. But I think it's really important to not let your emotions take a hold of you. And sometimes like when you are really sad that something's going down, some people have the tendency to just sell off the investment because they fear of losing money, but that's not how it works. If you're investing for the long haul, your investment will be going up over time, especially if you invested in the S&P 500. This sort of goes into the idea of dollar cost averaging, where you are buying at any point in the market, whether it's up or down. So you're just basically buying consistently over time. The idea is that your investments will sort of average out and those blips won't really matter as much. And there's a really great saying that time in the market beats timing the market. It's really easy to let your emotions take advantage of how you think about the market, but try to think of it as a more broader term and how you will feel about your investments growing like 30 years from now. So when it comes to investments, when you make a profit especially, something that can lose you a lot of money is taxes. You want to hold your investments for at least a year because there are tons of tax advantages when you hold your investments for more than a year. Every time you sell a stock or investment, the profit that you make will be subject to something called capital gains tax, which is what is taxed on the profits of selling an investment. If you sell your investment less than a year later, you are pretty much subject to something called short-term capital gains. Basically, it taxes you at the ordinary income, which is up to 37% for the highest income bracket, which is a ton of taxes. But if you hold your investment for at least a year and 1 day, at least, you can get taxed 0% if you are making $40,000 or less off of investment. So it's really important to understand a lot of these tax implications when you're investing and to try not to sell your investments that are less than a year old. You have to make sure to not fall for those meme stocks. I'm sure many of you guys have seen this in the news about stocks that are driven just by social media hype. Stuff like GameStop, AMC, stocks that just go up a crazy amount, and there's news articles featuring people who have made millions of dollars, and you get a sense of FOMO, but you can't fall for the hype. Like, a lot of these stocks are not driven by any sort of underlying fundamentals, and it's just through people on Wall Street Bets and Reddit like trying to get the price up really high. And when you hear these people making millions of dollars from this one stock, like, you don't hear about all the people who have lost everything by doing something like this. There's tons of people just out there making stupid decisions and losing everything, and you definitely don't want to be one of those types of people. Investing is not a get rich quick scheme. If you do it right, it should be really slow and actually kind of boring because you're waiting for like 20 or 30 years for it to grow into this big amount. The stories of people getting rich quick is not reflective of the wise investor. Definitely, I would just advise to stick with what you know, do your research, and just make sure you know what you're doing with your money because losing so much money is not a joke. And investing should be making you actually tons of returns into the future. So that was a beginner's guide to some of the basics to investing, and I hope it has inspired you to look into investing more and to take advantage of your biggest asset, which is time. A little investment now could be worth so much in a few years from now. Check out my other video on personal finance, on things you need to know about money as a student that school does not teach you. And don't forget to like the video, subscribe to my channel, and hit the notification bell so you get notified of new videos from me. And I'll catch you guys in the next video. Peace.